Assalamualaikum and hi everyone, and thank you for being here. My name is Dinarif. Our topic today is financial risk in Islamic finance. Let's start with type of risk. They are divided into two, which is financial risk and non-financial risk. Want to know more about it? Let's go. What is a financial risk? Financial risk is about the possibility of losing money or facing financial loss in transactions, investments, or business operations due to uncertainty, market fluctuations, defaults, or other unforeseen events. These are types of financial risk. So the first one is a credit risk, default by clients in murabaha or ijarah. And the second one is market risk, fluctuations in assets value. Third one, liquidity risk, difficulty converting assets into cash. The fourth one is operational risk, internal failures or errors. And last but not least, about Sharia compliant risk, which is violating Islamic law. Let me explain more details about it. The first one is a credit risk occurs in deferred payment contracts. For example, is murabaha, no interest charge, default increase exposure. Bank must assess creditworthiness carefully. And reshoring contract, mudarabah or musyarakah, reduce asymmetry but carry capital loss risk. Secondly, market risk arises from price volatility of underlying assets. For example, diminishing musyarakah and sukuk to market practices required, and asset-based nature exposure bank to higher market risk. And third one is liquidity risk. Islamic banks hold non-tradable or less liquid assets, limited access to Sharia compliant short-term funding, less developed Islamic money market in some regions. Sukuk insurance help but may not fully mitigate. The fourth one is operational risk, risk of failure due to internal system, people or processes. Unique to Islamic finance, need for Sharia governance, fatwa approvals and compliance checks, human error in contract structuring or interpretation of Sharia principles. And last but not least is Sharia compliance. Failure to comply with Islamic principles could lead to reputational loss, legal consequences and invalid contracts. Require Sharia supervisory boards, SSBS, and strict internal control. Next one is risk mitigation strategies. Risk mitigation in Islamic finance involves several key strategies to reduce financial risk while complying with Sharia principles. This includes conducting due diligence and proper client screening to avoid credit defaults, using Islamic insurance, which is takaful, to share risk and protect against losses, and issuing asset-backed sukuk to improve the liquidity. Strong Sharia governance ensure compliance and prevent reputational harm, while investment diversifications and risk-sharing contracts like mudarabah and musyarakah help spread and manage risk more effectively. So last but not least, let's jump into conclusions. Islamic banks face similar financial risks as conventional banks, but framed within Sharia compliance structures. The sources and uses of funds, guided by Islamic contracts, determine the type and extent of risk exposure. Managing financial risk in Islamic finance require ethical conduct, transparency, and strong Sharia governance. Proper risk management ensure stability, trust, and sustainable growth of Islamic banking operations. That's all from me. Thank you.